Did you know your $20 fast food meal used to cost just $10 a decade ago? Since 2014, the average price of fast food menu items has jumped by 63%, with some favorites, like those at McDonald's, doubling in price. For comparison, the average cost of eating out in the city has gone up 49% in the same period. So fast food inflation is outpacing even regular restaurants. Meanwhile, 78% of people now see fast food as a luxury, and most of us have been shocked by a bill recently. In this video, we'll break down the 3 big reasons why your favorite burger joint feels like a financial trap. From delivery app fees to rising labor and rent costs, we'll look at how the system turned quick, cheap meals into a wallet-busting disappointment. And it's not just about the price. Something else about fast food has changed, too. The broken promise of fast food. The original promise of fast food was simple, quick, affordable meals without the wait or the fuss. For decades, that formula worked. You could swing through a drive-thru, grab a burger and fries, and be back on the road in minutes. But that promise has eroded, and it's not just nostalgia talking. Industry data backs it up. Let's talk about speed. In 2014, the average drive-thru wait time was about 3.4 minutes. Fast forward to 2024, and that number has nearly doubled to 6.4 minutes, according to the InTouch Insight annual drive-thru study. That's not just a minor inconvenience, it's a fundamental shift in what fast food actually means. Even with some recent improvements, like the drop from 6 minutes and 19 seconds last year to 5 minutes and 29 seconds this year, the experience is still slower than what most people expect. But not all chains are created equal. Taco Bell, for example, has managed to keep its drive-thru times at an industry-leading 256 seconds, shaving nearly 23 seconds off its own average from the previous year. Meanwhile, Chick-fil-A, despite handling a massive volume of cars, still has some of the slowest average wait times at around 480 seconds. These numbers show that while some chains are making real progress, others are falling behind, and the gap between expectations and reality keeps growing. Industry-wide, drive-thru times have ballooned by 30% just since 2019, based on QSR Magazine's 2024 drive-thru study. The pandemic made things worse, but the slowdown started years before COVID-19 hit. In fact, McDonald's was already seeing slower service times compared to its own 2014 benchmarks. And now, with about 60% of orders coming in through digital platforms before customers even show up, the whole system is getting more complicated, not less. There's more to the story than just waiting in line. Customer service has taken a hit, too. The 2024 QSR Reputation ranking found a 6.9% increase in order mistakes and a 21.8% spike in negative comments about staff attitudes. Complaints about poor management practices have jumped by nearly 15%. Whether it's a wrong order, a cold meal, or an unfriendly interaction at the counter, customers are noticing the difference, and they're not happy about it. So why is everything so much slower and less reliable? One big factor is labor. According to CNBC, labor costs have risen faster than even food costs in recent years, with Jim Solera of North Coast Research noting that wage growth is outpacing historical averages. This has put pressure on franchise owners to do more with less. Many are running their drive-thrus with just 2 employees during off-peak hours, one person taking orders and payments, another assembling meals. That means a single worker might be juggling dine-in, drive-thru, and delivery tickets all at once. This staffing crunch isn't just about money. Fast food wages still lag behind other service industry jobs, making it tough to attract and keep employees. Turnover rates are sky-high, so restaurants are constantly training new, inexperienced staff. Chains that pay better, like Chick-fil-A in competitive markets, see lower turnover and faster service. But most locations are still stuck in a cycle of underpaying and understaffing. Menu complexity is another culprit. According to Nielsen data, the average fast food menu has doubled in size over the past decade. More options mean more ingredients, more custom orders, and more room for mistakes. Digital ordering has only made things more complicated, with customers tapping through endless customization options on their phones. Instead of a streamlined kitchen cranking out the same handful of items, workers now have to assemble a unique order for almost every customer. Even the physical layout of fast food restaurants is working against speed. Most drive-thrus still use single-lane designs from the 1980s, despite handling far more orders today. Some brands are experimenting with new concepts. Panera Bread has tested hybrid drive-thrus with heated lockers for mobile pickups, and Taco Bell's Defy locations feature 4 drive-thru lanes and vertical conveyors. But these innovations are the exception, not the rule. Legacy chains are slow to retrofit their real estate, so the majority of customers are stuck in outdated, congested lines. All these factors feed into a vicious cycle. Longer waits and worse service lead to bad reviews, which hurt sales. Franchise owners, in turn, cut labor even further to protect profits, making the problem worse. Some locations have even started locking their dining rooms during peak hours because they don't have enough staff to cover both the counter and the kitchen. It's a downward spiral that leaves everyone, customers and workers alike, frustrated. And here's the kicker. Despite the slower service and more frequent mistakes, prices keep going up. You're not just paying more in dollars, you're paying more in time, patience, and lowered expectations. The value proposition that made fast food a staple for millions of people is slipping away. So if you're wondering why that simple drive-through run feels like a test of endurance and your wallet, you're not alone. The industry's broken promise is now impossible to ignore. But the real shock comes when you see just how much more you're paying for the privilege. That $5 footlong at Subway now costs $12.99 in some locations. That's 160% inflation since 2008. The $20 burger lie. Let's talk about what's become known as the $20 burger lie. These days, grabbing a simple burger combo at a fast food chain can leave you staring at your receipt in disbelief. It's not just a handful of specialty items or trendy spots. Across the board, prices have jumped way past what most people expect from a value meal. The numbers are clear. According to Finance Buzz, fast food prices have risen by an average of 60% since 2014, while the Consumer Price Index for all items rose just 31% in the same period. That means fast food is inflating at almost double the rate of everything else you buy. McDonald's, for example, has more than doubled the price of some menu staples. The McChicken, which cost $1 in 2014, now sells for $3 at many locations, a 200% increase. Taco Bell's Crunchwrap Supreme, once $2.79, now goes for $5.29. Even Chick-fil-A's classic sandwich meal climbed from about $5 to nearly $9. These aren't isolated cases, they're part of a nationwide pattern. And it's not just about the big chains. Regional price differences can be shocking. A Shake Shack double cheeseburger costs $9.29 in Dallas and $12.50 in Manhattan. Airport and highway locations regularly tack on 20 to 30% more. These price hikes aren't simply a response to higher food costs. Grocery prices only went up by 31% in the same decade, while fast food menus soared almost twice as fast. What's behind this? The Bureau of Labor Statistics reports that fast food prices jumped 28% from 2019 to the first quarter of 2024, compared to a 19% increase for the overall CPI. So even as everything else gets more expensive, fast food is racing ahead. This has changed the way people think about eating out. In a LendingTree survey, 78% of Americans now consider fast food a luxury. Nearly 2/3 say they've been shocked by a fast food bill in the past 6 months, and 3 out of 4 believe it's cheaper to eat at home. Gone are the days of true dollar menus. Most chains have quietly replaced them with value bundles, or deals, that seem cheap until you realize the individual items cost much more than they used to. McDonald's, for instance, now advertises value meals starting at $3.99, which is 4 times the original dollar menu price. The idea of getting a full meal for under $4 is long gone. Even the so-called value options are just smaller portions at a higher cost per ounce. People notice. Social media is full of posts about $6 hash browns, $15 breakfast combos, and $18 chicken nugget boxes. But it's not just sticker shock. Customers are frustrated because they're paying more and getting less. The LendingTree study found only 13% of diners feel the food quality justifies these prices. In some cases, ingredients have actually gotten worse. Burger King switched to leaner, cheaper beef patties in 2021 while raising prices. Shrinkflation is everywhere. Large fries now come in smaller containers, drinks are downsized, and sandwiches are lighter than they were a few years ago. Meanwhile, corporate profits are up. McDonald's profit margins grew from 16% in 2012 to 23% in 2022, according to their own financial reports. Chains like Yum Brands, which owns Taco Bell and KFC, regularly report strong earnings and highlight strategic price increases to their investors. These companies aren't just passing along higher costs. They're using pricing power to boost margins and reward shareholders. The pandemic only sped things up. While labor shortages and supply chain issues were real, industry analysts say wage increases explain only about 20% of the total price hikes. Chains used COVID-19 as a reason for aggressive price jumps, and those prices never came back down. Internal documents from major brands show executives openly discussing how to test the limits of what customers will pay, using inflation as cover. Delivery apps have made things even worse. That $10 burger can easily become $15 or more after delivery fees and markups. Restaurants know that people using apps will pay extra for convenience, so the higher prices stick around even for in-store customers. Sometimes you'll even find different prices at the drive-thru, the counter, and in the mobile app, all for the same meal. The menu itself has gotten more confusing. Value bundles often cost more than buying items separately, if you actually do the math. Limited time offers appear at premium prices and then stick around, normalized by customers who have gotten used to paying more. Add-ons like bacon or guacamole, once 50-cent upgrades, now run $1 to $3 each. It's all about finding ways to nudge the average ticket higher. Younger generations feel this the most. Millennials who remember $1 burgers in college now see $6 versions of the same item. Parents post videos showing $50 McDonald's receipts for basic family meals that used to cost less than half that. For minimum wage earners, a single combo meal can mean nearly an hour of work after taxes. The value proposition that made fast food a staple for working families is disappearing. This change has shifted how people use fast food. When a Whopper meal costs $13, customers start comparing it to local diners or fast casual places that offer better quality for similar money. Fast food's core advantage, being the cheapest, fastest meal in town, is fading. Certain chains have leaned into this, targeting wealthier demographics and positioning themselves as premium options. McDonald's has even opened test locations for upscale drinks and menu items, chasing the Starbucks crowd. Taco Bell now offers $16 steak burrito bowls to compete with Chipotle. Franchise owners are feeling the squeeze too. Many report that higher prices have driven away regulars, with customers cutting visits from several times a week to once a month. Lower sales volume forces some to raise prices even more to stay profitable, creating a cycle that's hard to escape. Some franchisees push back against corporate-mandated price hikes, worried it's hurting their local business. There's also the issue of portion cuts. The large fry now fits in what used to be a medium container. Chicken sandwiches are smaller by weight, and orders come with fewer nuggets. According to USDA data, chicken sandwiches shrank by an average of 12% since 2016, even as prices soared. Discounting has dropped, too. Chains have reduced coupons and promotions by 40% since 2018, according to in-market data. App deals exist, but they often require jumping through hoops or spending more to unlock a real discount. International comparisons make the situation look even worse. The same Big Mac that costs $5.17 in the US can be found for $3.75 in Canada or $2.29 in South Africa, after adjusting for currency. US fast food is now among the most expensive in the world, despite lower ingredient and labor costs compared to many other countries. Corporate strategy documents reveal the thinking behind these moves. For example, a leaked Wendy's memo discussed surgical pricing increases targeting items popular with lower-income customers, betting that wealthier diners wouldn't notice. McDonald's investor briefings talk openly about pricing power, raising prices beyond what's needed to cover inflation, simply because the market will bear it. Even workers can't afford the food they serve. At $15 an hour, a McDonald's employee has to work nearly an hour to buy a combo meal after taxes. Many bring food from home, since even with an employee discount, the menu is out of reach. The irony isn't lost on anyone. Customers are responding. Many are trading down to smaller items or skipping fast food altogether. People who used to eat out weekly now go monthly, or switch to grocery store frozen meals for a better deal. Fast food's role as an affordable indulgence is fading fast. But there are signs of pushback. Chains are finally seeing resistance as more customers hit their price limit. McDonald's recently reported sales declines tied to price fatigue. The $20 fast food meal might finally be too much for many people, but don't expect prices to drop significantly anytime soon. With profit margins at record highs, these companies have little incentive to roll things back. So the next time you see a $20 burger combo, remember, it's not just about inflation. It's a web of corporate strategy, shifting menus, and pricing games that have changed the landscape of fast food.